Hello everyone and welcome back to the sessions on strategic financial management. Friends, in this class of strategic financial management, we are continuing with the small, simple but a very important topic, that is mutual funds, and this is the third lecture on mutual funds. I'm going to get started with a new concept in this class. You may please write the heading as concept of dividend equalization. Concept of dividend equalization. So let me explain you what exactly is dividend equalization and how we deal with this. Now for this purpose, try to just apply your simple common sense. Just assume that you are a business person. You just started a business by investing a capital of rupees 100. You started a business by investing a capital of rupees 100. You have operated for some period by which you have earned a net profit of rupees 6. So conceptually, your initial capital was 100 and now your profit that you have earned, which is not yet withdrawn by you, it is rupees 6. Now suppose I want to take entry into your business as your partner and I would want to be an equal partner with you, 50%. So how do I make calculations? I put forward a proposition that see boss, you have invested a capital of rupees 100 and now I will also invest a capital of rupees 100 and be your 50% partner. Point is, will you accept my offer of just investing rupees 100 and becoming your 50% partner, where the firm has already earned a profit of rupees 6 before I joined in as partner? Point is, you will not let this happen. You will not let this happen, because if I invest rupees 100 and become your 50% partner, I will start participating in that profit which was earned before I became a partner in this firm. So the point is, I am not supposed to share that portion of profit, and so to bring everything at parity, I repeat, to bring everything at parity, the calculations will be done little differently. How? You are someone who has started a business by investing rupees 100 and you have earned a net profit of rupees 6 which you haven't withdrawn. So logically, your capital balance at the date when I am joining is not 100 but 106. Therefore, if I want to be a 50% partner with you, I have to contribute not 100 but 106. If you can understand this simple logic of a partnership business, you can understand the same thing in the name of dividend equalization concept. So what exactly is the concept of dividend equalization? Suppose there is a mutual fund that has initiated some time back and there were some unit holders of that mutual fund. Now during this period, from the initial stage to this period, if the mutual fund has earned some income, that income belongs to only those unit holders who were into existence prior. Suppose the mutual fund is now issuing new units, it cannot issue new units at the opening NAV. It will have to make adjustment for the profit earned or the income earned during that period. For example, if I give you data for 1st of April and suppose I tell you that NAV on 1st April was rupees 20 and during the month of April the mutual fund has earned some income, logically that income belongs to only those unit holders who have invested their money during the month of April. Correct? During the month of April, who have kept their investment. Rather, I would say this profit, this income belongs to only those unit holders who have been the unit holders right from 1st April. But suppose on 30th April, if the mutual fund is issuing additional units, what will happen? Those additional units cannot be issued at the opening NAV of 1st April. Either it has to be issued at NAV of 30th April, and for any reason if that NAV was not determinable or not available, you have to take the opening NAV, that is NAV of 1st April, and make adjustment for the income, for the profit that was earned during the month of April, and that is what we call as dividend equalization. So you have to just consider one thing, that what is the point of entry, what is all about the initial payment made by any investor for acquiring new units. Now please understand one more concept that is coming into the picture. I have to discuss this point. There is something called entry load and exit load. Entry load and exit load. Now what exactly is entry load and exit load? Suppose I want to invest into a mutual fund, and the mutual fund company is asking, suppose 3% entry load. That means if I invest rupees 100, they will put that money into the fund, but the mutual fund company is charging 3% load. That means that 3% will not go to the fund actually, it will be going in the pockets of the mutual fund company, because they are charging an amount towards the services that they are providing to me. I am an investor, I am investing my funds, my fund will be getting invested in the market through this mutual fund, but this service will not be rendered to me free of charge, correct? Therefore, I am supposed to pay some fees. This fees can be collected from me at the point of entry, which is called entry load. This fees can be collected from me at the point of exit, which is called exit load. So suppose I am investing rupees 100 and 3% is entry load. What will happen? I will not have to invest rupees 100, I will have to invest 103. Likewise, if there is an exit load of 3%, and if the NAV prevailing on the date when the investor is selling the unit is rupees 100 with 3% exit load, investor will not get 103. Investor will be getting 100 minus 3%, that is 100 minus rupees 3, that gives you rupees 97. So if it is entry load, investor will have to bear the entry load. If it is exit load, investor has to bear the exit load. Therefore, when money is going out of investor's pocket, entry load will be added, and when money is coming back to the investor's pocket on redemption or repurchase of the units made by the mutual fund, exit load will be subtracted. So what I am going to do is, I am going to take a question which will include the concept of dividend equalization. It will also have adjustments for these entry loads and exit loads. So anyway, let us move to that particular example which is given in your textbook as question number 30. So please refer this question number 30 and let us read this question first. On 1st April, an open-ended scheme of mutual fund had 300 lakh units outstanding with net asset value of rupees 18.75. At the end of April, it issued 6 lakh units at opening NAV plus 2% load, adjusted for dividend equalization. At the end of May, 3 lakh units were repurchased at opening NAV less 2% exit load, adjusted for dividend equalization. At the end of June, 70% of its available income was distributed. In respect of April to June quarter, the following additional information are available. Portfolio value appreciation is given as 425.470 lakhs. Income for April, May and June is reported as 22.95, 34.425 and 45.45 lakhs respectively. Further in the question, what is asked? You are required to calculate income available for distribution, issue price at end of April, repurchase price at end of May, and net asset value, that is NAV, as on 30th June. Now let us systematically try out this whole process of calculation. So what you need to do basically, first you always have to make adjustment towards dividend equalization. So please carefully understand how we are going to solve this particular question. We have some value of the fund given on 1st April, that is beginning of April, and that day NAV was 18.75 and the date is 1st April, and there were 300 lakh units. So 300 lakh units multiplied by 18.75 will give you the total NAV of the entire fund as on that date. To that you are obviously going to add the income of April, so you get the closing balance of value by end of April, which will represent 300 lakh units. So any new units, if these are issued, these will be issued not at the opening NAV. You have to make two adjustments. One will be the entry load and one will be the adjustment for dividend equalization. What we will do, we will first make adjustment for dividend equalization, and at later stage we'll be making adjustment for the entry load and exit loads. So let us see how to write up the solution. In your solution, what you do is you begin for the month of April. Please first understand the entire working, then I'll give you time to note it down. First understand please. So as on 1st April there were 300 lakh units at rupees 18.75 per unit. So the total value would come to 5625 lakhs. To this you add income for April, and what you get on 30th April, the total value of the fund for 300 lakh units will be 5647.950, and this value when divided by 300 lakh units, you will be getting the value per unit. So this calculation what I have placed over there is the kind of value per unit as on 30th April. Now why is this calculation important? I explained you with the concept of dividend equalization that if you can figure out what is this amount per unit, that will become the adjusted value for any new investor to put in their money. So new investor cannot buy units now at 18.75. They will have to make adjustment for dividend equalization. This rate has not included the entry load yet. So we will specify over here that new 6 lakh units issued at 18.8265. You may please check with your calculator. 5647.95 lakhs divided by 300 lakh units would give you 18.8265 as per unit value, and because the entry load is not yet adjusted, you may write excluding entry load. Now can you please tell me what will you get if you multiply 6 lakh units to rupees 18.8265? The product is coming to 112.959 lakhs. Now obviously this was the value of the fund on 30th April. When you issue additional units, the value of the fund is definitely going to increase. So the revised value of the fund as on 30th April for 306 lakh units is coming to 5760.909 lakhs of rupees. Now what I want you all to do is write this working systematically, and then I take you ahead. Alright friends, once you have completed writing this whole thing, keep in mind whatever was the closing balance for April, that was 5760.909 lakhs, will become the opening balance for the month of May. So we move forward and make the calculations for May. As on 1st May, we have now 306 lakh units at 18.8265. That total value comes to 5760.909. You add income for May, and what you get as the revised value after including the income for May. So if that revised value, which is as at the end of May, that is 31st May, if you divide this by 306 lakhs units, you will be getting to know what exactly is the value per unit after including the income for May, and this is the value before the units were repurchased. We have been informed that as on 31st May, the mutual fund has repurchased 3 lakh units. So 306 lakh units were at 18.939, and that gives you 5795.334 lakhs. So when you repurchase, you will repurchase at this same price excluding the exit load. So I have not adjusted the entry load and exit load in any of these workings. Here we are making adjustments only and only for dividend equalization. So obviously on repurchase of these units, this much value, how we got this value? 3 lakh units multiplied by 18.939, which was the value per unit immediately before repurchase. This value will be subtracted from the gross value to arrive at the adjusted value for 303 lakh units as at 31st May of this year. So that value comes to 5738.517 lakhs, and this will become the opening balance for the month of June. But before we proceed to June, please write up all these workings and then only we shall move ahead. Alright friends, once you have completed this whole working, let us move ahead and make the calculations for the month of June. Now, as on 1st June, there were 303 lakh units at rupees 18.939 per unit. That gives you the total value of 5738.517 lakhs. To that you add the income for June, and what you get is the closing value for June. And when this value is divided by the total number of units outstanding on 30th June, that will be obviously 303 lakh units. What you get is the adjusted value per unit as on 30th June, and that is coming to 19.089. Please keep in mind one thing, these are not the NAV values, because NAV for this 30th June is yet to be determined. So first write up this working quickly and then I take you ahead. Alright friends, once your calculations for June are complete, let us move ahead. Calculation of total distribution. Now please carefully observe this working as well. The fund value as on 30th June for each unit we have just worked out as a 19.089. From this, if you subtract the opening NAV that was on 1st April, then from 1st April to 30th June, what is the income that is accumulated in terms of per unit? This is purely the income with the adjustment of dividend equalization only. That income per unit is 0.339, and if you can see, the fund has distributed 70% of the income, and 70% of 0.339 would come to 0.2373. So the dividend distribution will be 0.2373 per unit, and there are in total 303 lakh units. So when you multiply 0.2373 to 303 lakh units, what you get is rupees 71.9019 lakhs as the total amount of distribution. Please make the calculation and then I take you ahead. Alright friends, once you have completed this, let us move ahead and make the next working. That will be the price per unit for issue of 6 lakh units as on 30th April. Now what you have to do for this, remember when we computed the value per unit on 30th April, it was excluding the entry load. So now you have to make adjustment for the entry load, and entry load over here is given as 2% of opening NAV. So value per unit plus entry load at 2% of opening NAV, that will be 18.8265, which was the value as on 30th April after dividend equalization but before considering entry load. Correct? You can check your books. You would have got exactly the same value, that is 18.8265 per unit after dividend equalization adjustment but before the entry load adjustment. So dividend equalization adjustment is already done over here. Just add up the entry load over here, and entry load will be 2% of opening NAV, that is 2% of 18.75, and finally what you get is 19.2015 per unit. Similarly, you have to make one more working, that will be price per unit for repurchase of 3 lakh units as on 31st May. And how will you do that? Here exit load has to be subtracted, right? Entry load you will add, but exit load you will subtract. So value per unit as on 31st May, from that you will subtract the exit load, that will be again at 2% of opening NAV. So it is 18.939, which we found as the value per unit as on 31st May after dividend equalization but before adjusting the exit load. Now exit load will be subtracted. Why we are subtracting exit load? Understand one thing. Here we were adding entry load because this was the money that was paid by investor to the mutual fund company. So investor is making this payment plus incurring this as an expense. On the other side, when the mutual fund is repurchasing these units, this is the amount that the investor will get in his pocket as cash flow, and from that any amount of exit load will have to be deducted because that will be a payment made by the investor to the mutual fund company. On the other side, 18.939 is the amount that will flow from mutual fund company to the investor for repurchase of those units. So the effective price for this repurchase will be 18.564 per unit. Please write up these workings and then I take you ahead. Alright friends, once you have completed this much, let us move ahead and we take the last calculation, that will be closing NAV as on 30th June. Now this is not just any value, this is the NAV that will be quoted at end of this quarter. Quarter started on 1st April, quarter is ending on 30th June. Now all calculations will be in rupees lakhs. Opening NAV, which was the total value of 5625 lakhs. To that you add the portfolio value appreciation, which is given in the question, 425.47 lakhs. Whatever new units you have issued, 6 lakh units multiplied by 19.2015, we have just computed this price at which the fresh issue was taking place, and that comes to 115.2090, and you also add the income that the mutual fund has received from April to June. So April, May and June, all the 3 months income aggregated. So these are the components by which the value of the fund is increasing, but there are now certain components for which the value of the fund will come down. One will be units repurchased. 3 lakh units were repurchased at 18.564 per unit, and that comes to 55.692 lakhs. And then there was income that was distributed, that was 71.9019 lakhs. And finally what we get is closing net asset value for 303 lakh units as 6140.9101 lakhs. Therefore the closing NAV as on 30th June will be 6140.9101 divided by 303 lakh units, and that would give you exactly rupees 20.2670 per unit. So please write up all these calculations and that will be end of the solution.